If someone asked you the question, what affects the price of a company's stock more, news or opinions, what would your answer be? Here's the answer, and you can come to your own conclusion. News affects stock prices about 40% of the time, and the other 60% is due to the influences of opinions, believe it or not. It really is the opinions of the so-called experts that really drive the market. This is a huge business that continues to grow. It seems we are constantly looking for someone smarter than we are to explain what the news means. This may not be a wise choice, as we shall see. Here are some of the types of news that can affect the price of stocks. We have earnings reports, the report from the Federal Reserve Board, stock split announcements, the Dow and international stock exchanges or indexes, and my favorite, presidential or congressional news. Let's begin with what is likely the most meaningful news, a stock's earnings report. If the earnings are not what the expert analyst predicted, even if it is down only a few cents per share, the price of the stock is very likely to drop. If earnings are good, the price will go up accordingly. But who decides what earnings are good and which ones are bad? That is the key question. Can you tell just by looking at the earnings report what the reaction will be? Probably not. Therefore, I have a hard and fast rule regarding the earnings report. Never hold a stock or option just before the earnings report comes out. Let's find out why. Here's the news from the earnings for Intel Corporation. Santa Clara, California, January 15, 2008. Intel Corporation today announced record fourth quarter revenue of $10.7 billion, operating income of $3 billion, net income of $2.3 billion, and earnings per share of 38 cents. For 2007, operating income grew 45%, reflecting the company's ongoing efficiency programs, with profits growing significantly faster than revenue. How would this news affect the price of this stock? Let's go to the next slide and see about the rest of the report. "2007 was a breakthrough year for innovation at Intel. We realized the benefits of our investments in new products and our efforts to drive efficiencies. Our customers embraced the Intel Core microarchitecture. We enter 2008 with the best combination of products, silicon technology, and manufacturing leadership in our history. What do you think now? How do you think the marketplace will react to this news? Are you betting on a drop in price or a dramatic rise? Let's go to the next slide to see if you are right. Despite all the glowing news from Intel, it appears that the trading public and the big swingers are not all that impressed. Maybe they were expecting something even better. As this chart shows, Intel stock dropped 18% based on this outstanding earnings report. Now can you see why I have the rule not to own any stock or option as the earnings report comes out? Even when you know what the report is going to be, you never know what the reaction to the report is going to be, and that is what is really important. Now let's look at the news from the Federal Reserve Board. This report to Congress affects the interest rates of the banks and just about everything else. Don't buy a stock just before this report comes out unless you're absolutely sure what the report will be, and nobody is ever really sure. The reaction to this report and any rises or cuts in the key interest rates varies widely and is very unpredictable. My suggestion is to wait at least 24 hours after the report comes out and the dust settles before getting back into the market. In this 5-minute chart, you can see the initial exuberant reaction to a rate cut by the Fed. The NASDAQ jumped 30 points in just 15 minutes. So, should you jump into the market now to catch the wave? As you can see, the wave of enthusiasm right after the rate cut announcement didn't last long. By the end of the day, the market had dropped, and it dropped even more the next day until a late rally. This is why it is best to wait until the dust settles before trying to predict the future of the market. Here we have another news announcement that often drives the price of stocks upwards. Between 1 and 2 weeks before a stock splits, the price often begins going up. A good time to buy is just as it begins to go up. Catch the daily stochastic as it bounces up from 20. Don't buy too soon because it may start going down. Another good time to buy is the day the stock split is announced. We will discuss this in detail in a later lesson. In this chart, you can see some of the general characteristics of stocks that are splitting. First, we see the jump in price as the split is announced. This excitement lasted for about 2 weeks. The stock price bounced around during the next couple of months, and then 2 to 3 weeks before the actual split, the price starts its final drive, which continues for a month after the split, rewarding those who got in at the right time before the split. We will cover this in more detail later. We are now a world economy, and what happens overseas often affects what happens here at home. If the Dow or NASDAQ is in a nosedive, don't expect a stock to go up as much as your technical indicators tell you it should. Be careful when buying a stock when overseas markets are falling rapidly. We are now in a world economy, and what happens in Japan can affect our exchanges as well. This announcement is a perfect example of the effect world markets have on our own local markets. Global sell-off, a bad sign for U.S. stocks. Recession fears in the United States spark a big global sell-off and could hit Tuesday's markets. Crude oil takes a dive too. Earnings are due from Bank of America, Wachovia, and Johnson & Johnson. Apple reports after the bell. After a major sell-off in Asia and Europe today, U.S. stocks could be headed for an ugly open on Tuesday. What do you think? Will this affect our markets? As you can see, the markets here in the U.S. did open down after the announcement, but then rallied as the Fed announced a huge cut in the prime interest rate. Once again, it is news and opinions driving the markets. You can track trends of the various indexes the same way you track stocks. Here's a chart showing the NASDAQ and Dow Composite indexes along with the S&P 500. Trading in the same direction as the major markets is a key safety filter. You should always know in what direction the markets are headed. If you had been tracking this index, you would have seen at point A that it was time to close all your long positions and to start selling short. You can see the stochastic breaking below 80 and the MACD dropping below the center line, both clear indications of a major change. More on these technical indicators later. This chart shows the Dow Jones Industrial Average, and as you can see, it too signals a clear change in market direction. Here we have a daily chart of the Dow again, signaling when to buy long and when to go short. More on this later. One thing you can depend on politicians to do is to say things that make no sense to the rest of us. Markets react, at least for a short time, on the crazy things our leaders say. These can rarely be predicted, but can really mess up your plans. Generally, after a few days of a violent reaction, reality and common sense return, and the stocks continue in the direction they were originally headed before the crazy news. Here are some common news bites. Can you guess which way the stocks of these companies will head after this news? Generally, when one company purchases another, the company doing the buying takes on additional debt, and most often its stock will drop in price, while the company being bought out will have its stock price rise. And of course, rumors still drive the market. Here are some more headlines. All of these key terms will have an effect on the price of a company's stock. The question is, can you predict with any consistency what direction the stock price will move? The odds are against it. As we mentioned earlier, the opinions of the experts have the greatest effect on the price of stocks. Here we have an analyst boosting the price for Citrix. Let's see how this news will affect the price of this stock. Here you can see that the price of this stock rose from $80 a share to $90 overnight based on just the news. At one time during the day, the price hit $110 before falling at the end of the day. One of my favorite sayings is, "Take the money and run." This stock is a perfect example of why I use this phrase quite often. Generally, after a stock has a huge day like this one has, the pros will take their money to the bank. This profit-taking then drives the price of the stock down. Very often, this drop over the next couple of days will give back at least half or more of the initial big gain. You can see that 2 days after the big gain, the stock price is almost back to where it started. Much of the money being made in the stock market today would not be possible without the advent of the personal computer and the Internet. These two great tools allow you to gather information, store records, do technical analysis, and to create graphs, charts, and tables. Let's take a look at some of these tools now. Having access to information related to stock trading has changed the world of trading. This tool has effectively leveled the playing field between professionals and serious amateurs. Having access to technical indicators allows non-professionals to be able to determine trends of individual stocks as well as the market as a whole. The painstaking research previously done by hand late at night is now at our fingertips. Gathering information over the Internet, once you know where to look, is quite easy. You can find out just about everything there is to know about most companies. Be careful, however, not to get carried away with all this information that is now available to you. It is easy to get tied up with useless or semi-useless information and to miss the information that will actually make you money. You need to be selective so that you will spend only a little bit of time researching and doing most of your time making money. You can get their yearly earnings statement, any forms they are required to file with the SEC. You can find out when they are going to do a stock split or when their earnings report is going to come out, news, both current and past, and even information about the large stockholders. There really is no end to the information that is now available. One of the outstanding websites for trading is found on yahoo.com. At no extra charge, you can get stock charts, current day stock quotes, and a snapshot of the company, including products, officers, etc. Using expensive programs to do technical analysis can save you hundreds of hours of poring over charts. Once you've learned to use some of these tools, you'll be surprised how close you can come to predicting where your stock is headed and when it will change direction. These programs can track hundreds of stocks for you and can even beep you on your beeper when a stock moves past a parameter you have set. I would, however, not recommend that. You can program them to use your favorite technical indicators as a system. You can check your system on stock prices in the past to see if it really works or not, which in turn can save you thousands of dollars. Imagine backtesting a system before trying it with real money. You can then make minor adjustments and see if they improve your profit. When you are getting stock quotes online, there are several ways that you can receive them. You can receive them in real time, or you can get delayed data. As a beginner, you are much better off going slowly. If you receive real-time streaming data and charts, you may feel that you have to quickly make decisions, and as an inexperienced trader, this could be disaster. As a beginner, slow is better. To do this, all you need is to be able to receive stock data at the end of the day, analyze it, and be ready for the next day of trading. This information is available online at no charge. However, to be able to do a technical analysis of this data using your software, if you have purchased some, and your computer, you will need to download it. Due to your lack of experience, having to make quick decisions would lead you to rapid losses. Because of this, you should begin by trading medium to long-range positions. You can do this offline, that is, not using current active streaming data, rather data that has been collected during the course of the trading day. If you are an expert trader and have lots of experience, at some time you may decide to become a day trader. This means that you watch the market all day long, spot opportunities, and make decisions to buy and often sell stocks or options in the same day. To do this, it is important to have current streaming data so that you can get the jump on other traders by having the best information. This way you can react to the market quicker and get in and out of trades before the general market is aware of a new trend. This is not a game for amateurs, however. It does require some trading experience and skill. This requires not only lots of experience, but also a great deal of research and preparation prior to each day. Most day traders do not follow this pattern, and soon they are washed out of the market. Each evening, based on your research and technical analysis, you determine which stocks are about to make a change. You determine at what points you will either buy or sell these stocks. The second the price or technical indicator hits your predetermined level, you act. One of the least expensive services that provides real-time streaming data and charts is Telechart 2000 or TC 2000. Their prices are very reasonable and the quality of their product is good. Here is a sample of what their screens can look like. You can put a great deal of information on just one screen. This is a great program for beginners. Reading charts, either simple bar charts or those with lots of technical indicators, are your bread and butter. With experience, you can gain a great deal of information just by taking a quick look at a chart. The best way to learn how to read charts is by doing it. All the classroom learning in the world will get you only so far. This is much like learning a new language or other skill. The more you practice, the better you become. Before the advent of the PC and Internet, it wasn't possible to know what the market was doing. You were forced to rely on old news. Your best bet at that time was fundamental analysis. By the time the news got to you, it was only marginally useful. Things have really changed. Remember Dr. Elder's advice. To make money trading, you do not need to forecast the future. You have to extract information from the market and find out whether bulls or bears are in control. You need to measure the strength of the dominant market group and decide how likely the current trend is to continue. Let's now look at just how to extract this information from the market to find out who is in control. One of my favorite technical indicators is the MACD, or Moving Average Convergence Divergence Lines. It is a technical indicator that shows the balance of power between bears and bulls. It shows not only whether bulls or bears are in control of a stock, but also whether they are growing stronger or weaker. It gives strong signals as to when a trend is going to change. It is the changing of trends that we must be most concerned with, because that is our signal to buy or sell. This is a chart with the price bars on the top and the MACD technical indicator on the bottom. You will notice on the right of the indicator that the center line is at 0. When the histogram bars are above 0 or above the center line, the bulls are in control, and when the bars are below the center line, the bears are in control. The black histogram bars simply measure the distance between the blue MACD line and the red MACD EMA lines. As the red and blue lines cross each other, you can see the histogram bars crossing the center line. It is easiest to track the histogram bars and not to worry about the two lines. Our next technical indicator is the stochastic, or STC for short. It is a trend-following technical indicator. It tracks the relationship of each closing price to the recent high-low range. It includes several steps to filter out market noise and weed out bad or misleading signals. Here we have a chart with the slow stochastic. I use the slow stochastic instead of the fast stochastic because it gives fewer false signals. Do not confuse the blue and red lines of the stochastic with the blue and red lines of the MACD. They have nothing in common. Notice at the right side of the chart that the stochastic range is from 0 to 100. It can go no higher or no lower. The two critical numbers here are 20 and 80. These are referred to as reference lines. When the stochastic lines hit 20 and bounce up, it is a time to buy. As they hit 80 and drop, it is a time to sell a stock. This is not rocket science. More on this later. In the upper left of this chart, you will see the stock symbol, in this case IBM, and the chart frequency, in this case weekly. This means that each price bar on this chart contains 1 week's worth of price data. You can also see the type of technical indicator on the bottom of the chart. In this case, it is the MACD. You may have up to 3 technical indicators on the bottom part of the bigcharts.com screens. The top part of the chart contains price bars for the stock symbol IBM. On the far right of the chart, we have the price in dollars for this stock. If the stock exchange was in Germany, these numbers would refer to German marks instead of dollars or yen in Japan. As you look at the price bars, you will notice that there are 2 horizontal bars on each price bar. The one on the left indicates the opening price of the time period, and the one on the right refers to the closing price of the time period, in this case 1 week. The top of the price bar indicates the highest price for the time period, and the bottom refers to the lowest price of the period. As the MACD bars begin to tick downwards, it is time to sell your stock. After the bars level out and tick up, it is time to buy the stock. On this chart, you can see how a drop in the price of the stock is reflected in a similar drop in the stochastic as it dips below 80. As the stochastic hits the oversold area at 20, it then turns up and indicates a time to buy. Try not to buy a stock unless the slow stochastic is near or below 20. This will help to maximize your profits, and it will provide a great deal of safety in your trading. The stochastic is better at indicating buy and sell points when a stock is rolling rather than trending. For example, once the stochastic goes above 80 and approaches 100, it is like hitting the ceiling in your house. It can go no higher even though the price of the stock continues heading upwards. It gives no signal until it drops back down and approaches 80. That is why it is important to always check the MACD before making a final decision. You need to use both of these indicators in tandem to provide the best buy and sell signals. When you are looking for a stock to buy, how can you tell which one is best? Which one is most likely to make you the most money? When you are looking at dozens of stocks, how can you weed out the weak from the top performers? Let's take a look and see the easiest way. By far the best way to compare companies is not by the price of their stock or their growth as measured by increases in price. There are hundreds of points on which we can compare companies, but remember why it is that we buy stocks. It is to make money, isn't it? So why not compare stocks based on how much money they make? Rather, the best and only way to obtain a meaningful comparison is by comparing the percentage growth of the stocks. In this way, you are comparing apples with apples. Let's look at how much the price of the stock moves, because the more it moves, the more money we make. In other words, we make money from the volatility of the stock's price. If the price doesn't move, we don't make money. Does this make sense? If you had the chance to buy a stock that had gone up 40% in 3 months, you would certainly buy it, wouldn't you? But what if you had the chance to buy a different stock that had gone up 200% or even 500% during the same period? Which would you choose? As you can see in this chart, that is just the case with these 3 stocks. Of these 3, which would you choose to buy in the next week or 2? The correct answer is the ABOV stock. Why, you ask? The answer is that it has already made a big drop from its high in April, is leveling off, and is the most likely to head up in the near future. CUST looks like it may have peaked, and the odds are that it is ready for a drop or a correction at this time. If you have only limited funds to buy stocks with, you may be misled into thinking that you should buy only the cheap stocks because you will get more shares and that is all that you can afford. Most people don't think they can afford those $100 a share stocks. But is this true? However, it is the percentage growth, not the dollar growth of a stock that is important, and the actual price of the stock is not the most important consideration, as we shall see. For example, let's say that you have $1,000 to buy stocks with. Company A sells at $100 per share, so you buy 10 shares. The price of the stock goes up $10 to $110 per share, and you sell. You now have $1,100 or a 10% increase. Company B sells at $20 per share, so you buy 50 shares or 5 times the number of shares you could have bought for Company A. Company B shares go up $1.50 or 7.5% and you sell. You now have approximately $1,075. Buying more shares of a stock is not necessarily the best deal. More expensive stocks that have better percentage growth rates can be better. Of course, our real goal is to have the best of both worlds and to buy stocks with high percentage yields that are also fairly cheap. The key is not to be afraid to buy fewer shares of a quality stock simply because the price seems to be high. Now let's go back to reading stock charts. As we look at this daily chart, notice what happens to the price of the stock as the MACD crosses the center line. I wish I could say that stock prices jump this much every time the MACD crosses up, but they don't. Notice on May 6th how the MACD starts to tick downward, indicating a possible sell. This happens again on the far right of the chart. How do we know whether or not the MACD is going to cross up or down, or if we should stay in and hold the stock? Should we buy the stock when the MACD is below the center line, or should we wait until after it has crossed? These are important questions. Let's see if we can find the answer to these. Knowing your time frames is critical to making good buy and sell decisions. On the previous chart, it appears initially that it may be time to sell because the bulls are losing control. Let's see how that plays out. However, if you had looked at the weekly chart, it showed the bulls still gaining strength, which would tell you that the bars will probably not go below the line, indicating that the bears had gained control and that the price would be dropping. More on this in a few minutes. Stock prices go up and down daily as thousands of people buy and sell based on their understanding of the market and their personal goals. This is a normal market occurrence. Price trends are jagged lines, not smooth and straight. Always start by looking at the long-term trend of a stock. That way you won't be fooled by a short-term change in price direction. When I say long-term, you should look at the 6-month weekly MACD to determine that direction. If the long-term weekly chart trend of a stock is up, don't be scared into selling if the price drops for a day or two. This is normal. Setting your protective stop-loss orders too close will cause you to get kicked out of the stock prematurely, so be careful. Conversely, if the daily chart trend shows a stock going up, don't jump right in and buy. If the long-term or weekly trend is down, you will buy high only to watch the price tumble and your account balance shrink. If you are a long-term buy and hold type of trader, you need to follow the long-term trend of a stock and not be fooled by short-term price dips as in this chart. Always check the volume on any stock you are considering buying. If the volume is real light, 500,000 shares per day or less, stay away. The greater the volume, the easier it is to get in and out, and the less chance for manipulation. Many stocks that are highly touted are in fact very low volume and highly manipulated. Watch for a change, however. If a stock is trending, that is, heading steeply in one direction, and the volume is good, it will probably continue in that direction. If the volume is getting lighter each day, you are probably going to see a change in the direction of the price. Although volume is not the most precise indicator, it does signal a change, and as volume increases, the price usually goes up as well. If the price goes up, but the volume begins to drop, this is often a sign of manipulation, which can last for several days before the price begins to drop. On a price bar chart, check the price spread for the day. If there is a large spread, this means a volatile market, great for playing options and day trading. If the daily price spread is shrinking, the price is getting ready to change direction. Take note of the differences between the opening price and the closing price. If there's a small difference, there could be a change in price direction coming. If there's a big difference, you could be in a trend. The stochastic will give you the same information in a different format. When looking at any indicator, we are simply looking for patterns. We want to see what the price of the stock does when the indicator moves in one direction or another. Always look for patterns in the stocks you are watching. Does the stock seem to rise to a certain point over and over again and then drop? After it begins dropping, does it seem to hit a certain level and then begin to rise again? We call these ceilings and floors or support levels. By paying attention to these, you can get to know your stock and what to expect. How many days in a row will the volume rise before it starts dropping off? Is the volume abnormal? Does the price drop a few days after a big rally, then go back up? These and other patterns can be very informative. The charts used in this presentation are gratefully printed here with permission from Phil Hotchkiss at Big Charts. Their charts are one of the few free charts on the internet that I know that include all the technical indicators which are essential in trading stocks. They are one of the first and the best. We do thank them for their outstanding website and their permission to use their charts in this presentation. Their website is located at www.bigcharts.com. Take your time and become familiar with their website. We will refer to it often. With Big Charts, you have several options for technical indicators. You may look at 3 indicators at a time, and you can still get the information you need to make intelligent, informed trades for free. This website will allow you to get started without spending a lot of money on software. As you accumulate more money, you can buy the software you need, such as TradeStation, to do more complex searches and analysis. They cost about $15,000 to open an account. Or you can subscribe to TC2000 for about $90 a month and get real-time charts with technical indicators. TradeStation allows a much greater flexibility with the charts than do the canned but free websites, and as your trading progresses you may want to look at them. In addition, the program does much more than just produce charts. It allows you to design your own technical indicators or to modify existing indicators to your own needs. It also allows you to test your theories and systems on historical data to see if they work. You can also use this program to filter, looking for specific stocks meeting your criteria. We will look at this software in more detail as we move along. Technical analysis is applied social psychology. It aims to recognize trends and changes in crowd behavior in order to make intelligent trading decisions. As you look at stock charts with technical indicators, what you are actually viewing is a visual representation of traders' emotions. You are looking at crowd behavior. The technical indicators discussed here are but a small number of those in existence. These indicators are not magic. They simply indicate what might happen. They allow you to stack the odds in your favor, and that is the best we can do. The more you become familiar with them, the more meaning they will have for you. No one indicator tells the whole story. In order to be successful, you must use several of them together. If several indicators give the same signal, you have a much greater chance of success. The key is to spend many hours watching the market using these indicators and noticing the relationship between the changes in the indicators and the prices in the market. Just like learning a new language, the more you practice, the more fluent you become. The key to understanding the market is knowing who is in control, the bears or the bulls, and whether their control will continue or is about to change. We use the MACD indicator to determine this. Now let's look at volume a little more, as it can confirm what we see with our technical indicators. Remember, volume is an indicator of interest. As interest increases, so does price. As interest wanes, so does price. Here are some tips when looking at volume. An increase in volume during an uptrend calls for higher prices ahead. Buy or add to your long positions. Prices jump on more than double the average volume. It is a sign of a potential blow-off move. Tighten your stops on long positions. When the price falls to a new low, but volume is lower than it was earlier, this is a typical retest of a climax bottom. Cover your short positions and go long. When volume is quiet, it is often a good time to prepare to buy at a good price. Now let's look at the stochastic again. The stochastic indicator tracks the relationship of each closing price to the recent high-low range. It appears as a line on the stock chart, and as it reaches a high point, 80, or a low point, 20, it indicates that a change is about to take place in the direction the price of the stock is moving. Here we have a weekly chart. Notice the number of bars the stochastic is averaged over to give us our lines. Shorter averages will give us more turns, but can lead us to whipsaws as the lines bounce back and forth. Longer averages are more stable and lead to fewer misleading signals. As the weekly stochastic hits 20 and bounces up, is a great time to buy a stock. This is true for long and short-term traders. A narrow window, 5 days with big charts, helps to catch more turning points, but a wider window, 14 to 21 days, helps identify major turning points and is a little more consistent. The slow stochastic does a better job of filtering out market noise and leads to fewer whipsaws and leads to fewer false signals than the fast stochastic. Because of this, even when I day trade, I still use the slow stochastic instead of the fast. It's just more reliable. The most powerful buy and sell signals of the stochastic are given by divergences between this indicator and prices. This will give you the big price jumps. A bullish divergence occurs when prices fall to a new low, but stochastic traces a higher bottom than during the previous decline. As soon as stochastic turns up from its second bottom, it gives a strong buy signal. The first upward bounce from a bottom is due to a few aggressive traders who want to catch the big price jump as the downward trend changes. Very often, because of their small numbers, they are not able to carry the day and the price drops back down. As the stochastic bottoms out the second time, a little higher than the previous time, more traders are convinced that a bottom has been reached and are willing to jump in, driving the price up. This second bounce will often drive the price up faster and for a longer period of time, and as a result is often safer for beginning traders, although it doesn't occur all the time. At the other end of the scale, we have a bearish divergence, which occurs when prices rally to a new high, but stochastic traces a lower top than during its previous rally. As soon as stochastic turns down from its second top, it gives a strong sell signal. Go short and place a protective stop above the latest price peak. These signals work fine during trading ranges, but not when a market develops a trend. During a trend, the lines tend to stay above 80 for long periods, or dip, giving a sell signal when you should stay in as a long-term trader. Once you are long, place a protective stop below the low of the trade day or the previous day, whichever is lower. When you identify a downtrend on a weekly chart using the MACD, wait for the daily stochastic lines to rally above their upper reference line, which is 80. Then, without waiting for their crossover or a downturn, place an order to sell short below the low of the latest price bar. We will cover shorting later in detail. Now let's look at some more tips. When prices rise and both stochastic lines rise, the uptrend is likely to continue. Here we simply have two indicators giving the same signal, which increases our odds of success. Now let's get back to the importance of looking at different time frames. When first getting to know a stock, look at different time frames. 6 months will give you a good idea where the stock is headed long term. Then narrow down your time frame to the past month and then week. Then as you get closer to buying, look at the last few days. This will help you to get more precise entry points, which will increase your profits. If you want to carry a trade for several days or weeks, then your intermediate time frame will be identified and defined by the daily charts. Weekly charts are one order of magnitude longer, and they determine the long-term time frame. Hourly charts are one order of magnitude shorter and determine the short-term time frame. If you look at the screen in front of you, you will notice that it has two dimensions, length and width. When looking at stock charts in only one time frame, it is much like having only two dimensions. By adding the third coordinate or dimension of depth, you have a much more realistic view of the object you are looking at. By adding various time frames to your stock charts, you have a much more precise view of the direction your stock prices are heading at any given time. By adding time to your charts, you put them in context. Without this context, they are only of limited value. Trade only in the direction of the long-term time frame. If the long-term charts are in an uptrend, trade only the long positions, buy low and sell high. If the long-term trend is down, trade only from the short position. Use the intermediate and short-term time frame charts to find entry and exit points. To determine your long-term time frame, always look at the 6-month weekly MACD. This works well with BigCharts.com. Whichever direction the MACD is ticking, that is the direction you should trade. If it is ticking upwards, as in this chart, you should only trade long positions. If it is ticking down, you should only short the stock. More on this later. This is a major safety rule that you should rarely, if ever, break. Now let's look at Dr. Elder's triple screen trading system that I have been using for many years. The first screen we look at is the market tide. This is done with the weekly charts and the MACD. This determines the direction of our trade. Once we have established the direction of the tide, we need to find the ripples in the tide for our best entry points. A single uptick or downtick of the weekly MACD histogram indicates a change of a trend. The upturns that occur below the center line give better buy signals than those above the center line. The downturns that occur above the center line give better sell signals than the downturns below the center line. These signals will give you greater price jumps and thus greater profits. You can still make money with safety on the other side of the center line, but the price jumps will generally not be as large. You should always confirm the signals from one indicator, in this case the MACD, with another indicator, usually the stochastic. When they both give the same signal, you can be much more secure in your trade. If the signals are not the same, something is wrong, sometimes manipulation, and you are better off going to another stock or simply waiting. Our second screen is the market wave. These are deviations against the trend and are buying and selling points. We use our 1 month daily stochastic to determine our ripple against the tide. This will give us our most precise entry points. The ripple should always be the opposite of the tide. When the weekly MACD histogram rises, but daily stochastic falls below 30, it identifies an oversold area, a buying opportunity. When the weekly MACD declines or ticks downward, but the daily stochastic rises above 70, it identifies an overbought area, a shorting opportunity. Here you can see the best time to buy and sell this stock using the stochastic. This is the type of chart long-term traders should be looking at for their entry and exit points. The final screen of this system does not require a technical indicator per se. Rather, it requires price charts that will show price action. It identifies the ripples in the direction of the tide. It uses intraday price action to pinpoint entry points. When a stock's price has been heading down for a while, it will eventually hit a bottom. This bottom will usually end with a large jump in price and volume. When you see this, you will know that the tide has turned. Here is a chart that summarizes what we have just talked about. When we talk about the weekly or long-term trend, we look at the 6-month weekly MACD. When we refer to the daily trend, we use the 1-month daily stochastic. Based on these two trends, we have recommended actions along with the type of order we can use. As an example, in the first row, if we have a weekly trend that is up, this means the 6-month weekly MACD is ticking up. The daily trend up means that a 1-month daily stochastic high approaching 70 or 80. The recommended action is that we should stand aside, meaning we should go golfing or shopping or anything else but trading. These guidelines, if followed, will keep you out of a great deal of trouble. One of my favorite free websites for trading stocks is Big Charts. At this time you should be in front of your computer so that you can go online. Go through the next few slides to see how to set up Big Charts, and then go to the website and actually set up the program. And then I suggest that you save it to your favorites folder as explained. After you have typed www.bigcharts.com onto the address line of your computer screen, you will see this web page. Choose the red Advanced Chart button. We will now begin setting up Big Charts. The first place we go is to the time frame box. We will set the time to 6 months and the frequency to weekly. By doing this, the chart that we call up will have 6 months worth of data, and each price bar will contain 1 week's worth of data. This assumes that it is Friday and that you have had a full week to gather data. Next, we will set up the technical indicators. We will set up the MACD, stochastic, and volume indicators. Next, we will size our screen by going to the chart style. Here we can zoom in or out depending on the size of the computer monitor we are using. Once this is complete, our setup is done and we need to save our settings so that we don't have to do them again each time we use the website. We then go to Store Chart Settings. Finally, after this last step, we go to our Internet browser and save this page to our favorites. Let us now begin using this website. When you choose the Time button, these choices will pop up. Choose the 6-month button. Now choose the Frequency button and these choices will pop up. Choose Weekly, as this will show us the long-term trend of the stock we choose. We can also use this to look for charts for the various stock indexes such as the NASDAQ or Dow Jones Composite 100 or the Standard & Poor's. If you choose the Indicators button, this screen will pop up. Here we choose the indicators that we want to see below the price bars on our screen. To do this, we will choose only the lower indicator boxes at this time. First, choose Lower Indicator 1 and then choose the MACD indicator by clicking on it. Next, go to Lower Indicator 2 and choose the Slow Stochastic. Finally, choose Lower Indicator 3 and choose the Volume Plus. You have now set up your technical indicators. When you finish your indicators, they should look like this. If not, go back and change them as needed. Now it's time to enter a stock or index to actually look at. I suggest using the $COMPX because we will be saving this setting, and that way each time you open this web page using your internet favorites, the screen showing the long-term market trends will come up first. This way, before looking at any individual stock, you will automatically look at the market trend first. This is something that is always good to do. It will add a layer of safety to your trading. Once you have entered the symbol, choose the Draw Chart button. In this example, I have used the stock symbol CSCO. You can see the chart that comes up shows data for a 6-month period. At the top of the box, you can see the data for this day's trading. Let's go to the next screen to take a closer look at this data. The first thing we notice is the stock symbol that we have entered, in this case Cisco, which is the symbol for Cisco Systems. Next, we see the last sell price for this stock, in this case $24.39. To the right of the price box, we can see how the price did compared to the closing price of the day before. Here we see that today's price is 27 cents lower than yesterday. This number is not as significant as the one below it. This box shows the percentage change, in this case 1.09. It is easier to compare stocks, or in this case to assess a change in price by looking at percentage changes. A 1-point change in a stock's price is not a significant change. A 3 to 5% change is very large, and anything over 5% is huge. Back in 1999, this was not the case. It was common back then to see 10 and 20% changes on a daily basis as the market was truly going crazy. Those days are over and will likely never return. As we continue to the right, we can see the opening price of the day and the highest and lowest prices of the day. We also have the volume for this particular day, which is not to be confused with the average daily volume, which is of critical importance. Another indicator we see is the PE ratio. This number is not always available, but is helpful in comparing stocks where everything else is equal. The lower the PE ratio, the better. Below 30 is great. Now let's choose the Detailed Quote button to take a look at some of the important fundamentals of the stock we have just chosen. This screen will show us some of the important information we need to about a stock before we buy. Some of the items are critical for our safety. Others are simply somewhat helpful. The two most important bits of information contained here are the market capitalization and the average volume. These are our safety filters. We use them to protect us from fly-by-night stocks and those that are easily manipulated. Stocks with a market cap of over $500 million are less likely to take a dive when the market is doing poorly or when the economy is crashing. They are simply more stable. Next, we look at our average daily volume. Here we have two sets of numbers. One is the 50-day average, and the other is for 200 days. You can use either. The critical thing is that both of them should be over 500,000. This means that on an average day, over 500,000 shares are traded. If you want to add more safety or stability, just raise your standard on both of these fundamentals. However, be careful, because by raising the standard, you will eliminate some very good stocks with high growth rates. Two other fundamentals that are also very helpful, especially for long-term traders, are the PE ratio and the 52-week EPS or earnings per share. The PE ratio, if available, should always be below 60, and the closer to 20 or 30, the better. The lower this ratio is, the more the price of the stock has to grow, as opposed to a stock with a high ratio, which is most likely to begin dropping soon. If you are doing some long-term trading, you will want the 52-week earnings per share to be over $1. These will be stocks that are actually making money and are well-run, profitable companies. The higher this number, the more stable the stock will be. This is, of course, what you need as a long-term trader. Now let's go back and look at the chart by hitting the back button in the upper left of the screen. As we look at the upper portion of the chart, the first thing we note is the stock symbol. Each of these bars is a price bar. On the left, we see the horizontal bar, which indicates the opening price. On the right, we have the horizontal bar that indicates the closing price. On the far right, we have the price in dollars. On the lower portion of the chart, we have our technical indicators. On this chart, we have the MACD and slow stochastic and the volume plus. As we take a closer look at the MACD technical indicator, take note of the center or zero line. When the histogram bars are above this center line, we say that the bulls are in control of the stock, meaning that the prices are likely to be going up. As the bars go below the line, we say the bears are in control and that the price is likely to be going down. Notice what happens to the price as the bars cross from above to below the line in the month of November. The histogram bars represent the distance between the MACD and EMA lines. These lines are not to be confused with the lines found in the slow stochastic technical indicator. In this chart, we have the slow stochastic technical indicator. Notice that we have two lines that are averaged over different periods of time. The fast line will catch changes in price earlier than the slow line, but can give misleading signals. However, when used in conjunction with other indicators like the MACD, it is the one I use to determine the most likely direction of the stock. Do not confuse these lines with the lines found on the MACD. They have absolutely nothing in common. On the right, we have numbers from 0 to 100. The scores for this indicator can go no higher than 100 and no lower than 0. The key numbers to notice are 80 and 20. 80 is the upper reference line and 20 is the lower reference line. When the lines are above 80, we say that the stock is overbought, meaning that traders are paying too high a price and the odds are that the price will soon be dropping. If the stock is a strong trending stock, the daily stochastic can stay above 80 for days or even weeks before finally dropping. If the stochastic lines are below 20, we say the stock is oversold and likely to turn up soon. Again, if we have a weak stock, it can stay below the line for many days or several weeks. Strong stocks usually don't stay below this line for very long. Before evaluating this indicator or the MACD, it is important to first determine what type of stock we are evaluating. Depending on the type of stock we are dealing with, we will look differently at the charts. Generally, when the daily stochastic drops from above 80 to below, it signals a sell order. When it is below 20 and turns up, it signals a buy. Because the stock market is such a ruthless game to play, it is imperative that you arm yourself with as much information as possible. This pursuit for information never ends. New technologies become available in the form of software, and new valuable websites are always popping up. The market changes and new strategies are often required. One way of gathering information is by reading good books. One of the best books to read as you begin trading stocks is Trading for a Living by Dr. Alexander Elder. This book quite literally changed my life as it gave me correct trading principles, allowing me to at last become a successful trader. Portions of this workshop were taken from concepts in this book and lessons learned due to reading and practicing the concepts of Dr. Elder. It includes a study guide which is also very helpful to make sure you understand the concepts presented. There are a few books in the same class as this one for helping traders to understand how to actually trade. Students of this class can receive this book autographed by Dr. Elder at a discount by purchasing it through his website at www.elder.com. As you buy the book, on the last screen where you put in your credit card number, there is a box for comments. In that box, type in Larry Kowallis Stock Market Class Discount. There are quite a few quality websites for trading and investing information. Here is one of them. Reading articles from different sources can be a great way to gather information about the market and about trading. Here are a few places you can go to purchase your investing books. A second way to learn about trading stocks is similar to the first. If you have access to a computer and the internet, you can learn online. This is how I get much of my news and trading information. There are several good sites to choose from. One website I recommend is particularly good for beginners. It is called the Investment Fact and can be found at investfact.com. This website has a great deal of information about many investing topics, and it is free. This is an outstanding place for young people to begin learning the skills they will need as adults. Another way to gain knowledge about the stock market is by attending seminars. Some of them are very good. Others, while not devoid of value, are more sales pitches than anything else. Very often they begin with a free lecture and then invite you to spend thousands of dollars to actually learn how to do anything. Be careful not to leave a seminar by giving money to others to invest for you. In most cases, you are better off learning for yourself and investing your own money. The time you spend learning to do it yourself will be well spent. It does take more time, but you then have control over your own future. Be very leery of seminars that promise you that within a year or two you can be a millionaire by using their methods and their company and giving them your money. Christopher Lott, who set up the InvestFact website, sums up my feelings regarding most investment gurus and seminars. He says, "People who know next to nothing and always depend on professional advisors to handhold them through all transactions are simply sheep asking to be fleeced. They may not actually be fleeced, but most of them will at least get their tails bobbed."